Hello everyone, my name is Chuma, and on this channel we break down how money, power, and global events shape wealth. Today we are talking about something that sounds like politics, but is actually one of the biggest financial stories in the world right now. The war involving Iran is not just a military conflict, it is shaking oil markets, global inflation, stock markets, food prices, and even interest rates. But here's the thing most people miss. Every major geopolitical crisis in history has destroyed wealth for the unprepared and created massive opportunities for investors who understand the cycle. So in this video, we'll break down how the Iran war is affecting global finance, why markets are reacting the way they are, the economic opportunities that often emerge after wars, and what serious investors should be watching right now. Let's start with the most important piece of the puzzle. Part 1. The real financial trigger, oil. Whenever conflict erupts in the Middle East, there is one asset the world watches immediately, oil. And Iran sits right beside one of the most important energy choke points on earth, the Strait of Hormuz. About 20% of the world's oil supply passes through this narrow channel. If that route becomes unstable, global energy prices move almost instantly. And that's exactly what we are seeing. Oil prices have surged dramatically, with Brent crude rising above $100 per barrel in some trading sessions. And analysts warn prices could rise even higher if disruptions continue. Why does this matter? Because oil is not just fuel. Oil affects transportation, electricity, plastics, fertilizers, manufacturing, and food production. So when oil rises, almost everything becomes more expensive. Economists call this a global inflation shock. Part 2. The inflation ripple effect. When oil rises, the effect spreads through the economy like waves. Shipping becomes more expensive. Air travel becomes more expensive. Factories pay more for energy. Farmers pay more for fertilizer and fuel. Even food production becomes more expensive. In fact, fertilizer prices have already surged dramatically since the conflict began, threatening agricultural output and global food supply chains. That means grocery prices eventually rise as well. So central banks around the world suddenly face a difficult problem. They were planning to cut interest rates this year to stimulate economic growth. But now, inflation may rise again. And if inflation rises, central banks may have to keep interest rates higher for longer, which slows down the economy. This is why analysts are warning the conflict could increase the risk of global recession if energy prices stay high for too long. Part 3. Why financial markets are so volatile. Markets hate one thing more than anything else: uncertainty. War creates massive uncertainty. Investors suddenly don't know how long the war will last, whether oil infrastructure will be attacked, whether shipping routes will reopen, whether sanctions will expand. And this uncertainty causes massive volatility in financial markets. Stocks fall, oil rises, the US dollar strengthens, and investors move money into safe haven assets like gold, government bonds, defense stocks. But here's where it gets interesting. Because while some sectors suffer, other sectors explode upward. Part 4. The industries that benefit from conflict. Historically, several industries benefit during geopolitical crises. First, energy companies. When oil prices rise, companies involved in oil production often see increased profits. Second, defense companies. War increases military spending. Governments begin purchasing more aircraft, drones, missiles, cybersecurity systems. Third, shipping and logistics companies. When shipping routes become dangerous, freight rates often surge. Fourth, commodities. Investors often move money into real assets like gold, oil, natural gas, agricultural commodities. This is why analysts note that oil and shipping stocks have already surged since the conflict began. But the biggest opportunity might actually come after the war ends. Part 5. The post-war economic boom. History shows something fascinating. Major wars are often followed by huge economic reconstruction cycles. After World War II, Europe experienced the Marshall Plan rebuilding boom. After the Iraq War, Construction and infrastructure companies surged. Why? Because rebuilding a damaged region requires enormous spending. Infrastructure, energy systems, telecommunications, housing, transportation, financial systems. And if the Iran conflict eventually ends with political change or economic reopening, Iran could suddenly become one of the largest reconstruction markets in the world. Remember, Iran has over 85 million people, enormous oil reserves, massive infrastructure needs. If sanctions eventually ease and rebuilding begins, global corporations will race to invest. That includes companies in energy infrastructure, engineering, telecommunications, construction, and banking. Part 6. What serious investors are watching right now. Professional investors are not just watching the war, they are watching signals. Signals that tell them when the market is about to shift. Some of the biggest indicators include oil prices. If oil stabilizes, markets often rebound quickly. Shipping through the Strait of Hormuz. When tanker traffic resumes, risk premiums fall. Diplomatic negotiations. Peace talks often trigger huge market rallies. Sanctions policy. If sanctions ease, capital flows into previously restricted economies. Smart investors position themselves before the headlines change, because markets move months before the public narrative shifts. Part 7. The biggest lesson in global finance. Here's the truth about geopolitics and investing. Wars create fear. Fear creates volatility. Volatility creates opportunity. The biggest fortunes in financial history were often made during periods of maximum uncertainty, not because investors predicted the future perfectly, but because they understood how the system reacts to crisis. Energy shocks, inflation waves, government spending, reconstruction cycles. These patterns repeat again and again, and the investors who study them position themselves early. If you found this breakdown useful, make sure you like the video, subscribe to the channel, and share it with someone who wants to understand how global events affect their money. Because on this channel, we don't just talk about finance, we talk about how the world actually works and how you can position yourself financially inside it. And remember, the biggest opportunities in markets often appear when the world looks the most uncertain. I'll see you in the next video.